okay? And you remember we said capital allowance is an allowance granted to a taxpayer that has incurred qualifying capital expenditure and put same into production use at the end of the basis period, okay? So that is very important and that is very essential that we know that capital allowance is also a replacement for depreciation. So instead of allowing depreciation, we say depreciation is not allowed because of the various reasons I gave last class. One of the reasons is inconsistency in the application of the method of depreciation, and depreciation does not also involve movement of cash. So that was one of the reasons why we said it is not going to be an liable deduction. So I'm going to be sharing my screen now so that we continue from where we stop. Okay, let me know if you can see my screen. Um, okay, so in our last class, I don't know, maybe we discussed um, the tax implication um, of capital allowance or cessation. Did we discuss that? Or where did we stop exactly? I can't remember. Please pardon me for that. Who remember where we stopped?
We solved the illustration 11.
Okay, that means we've gone beyond that then. Okay, let's look at illustration 12. Thank you for that. Trying to expand my screen. Okay, good. Illustration 12. Okay. Yeah, we did decay last week. Yes, that's true. I remember now. Illustration 12. Aisha Sheets, Nigeria Limited commenced business as a trading company on 1st April 2022. The result of the company for the first 5 years of commencement of business were as follows. So we are given the profit of the company. This is actually on commencement. For those of you that did not meet commencement rule, this is another opportunity for us to look at what commencement rule says. Now we're given a 5-year profit about 1, 2, 3, 4, 5. About 5-year profit. That is what we're given. Okay. And again, the examiner also now told us that the company acquired the following qualifying capital expenditure. They gave us the description of the asset that was acquired. They gave us the date of acquisition. And we're also told that building was sold on 4th of August 2025 for 80 million. You are required to compute the capital allowance claimable by the company for all the relevant years of assessments, compute the balancing charge or balancing allowance if applicable, if any rather, and also compute the company's income tax, compute the company's income tax for the relevant years of assessments. Now, the first thing you need to do when you have a question like this is for you to do your asset allocation schedule. Is for you to do your asset allocation schedule. Now, what do we mean by asset allocation schedule? Because you do not know where to introduce your asset for capital allowance purpose, your asset allocation schedule would help you in allocating the asset to the relevant year according to the basis period that you have established. Before now, when we were still using the old tax law, this used to be very, very important. And I'll tell you the reason. The reason for this is that in the old tax law, because of the abnormality in the basis period, there's every possibility that the taxpayer will not know where to allocate the assets. Imagine, you remember in the old tax law where we say when a company commences operation, the company will be assessed to tax from the date of commencement to the end of the year. We say in the second tax year, from date of commencement again to the first 12 months. In the third tax year, we say on the date of commencement on preceding year basis. When you look at these three things I've said, you will notice that there is overlapping of basis period. So imagine an asset acquired within those periods. The taxpayer might not be able to allocate the assets to the relevant year in which the asset was acquired. Okay, let me give you an instance. Okay, let us assume excuse me. Let us assume I want to bring up an account. A company commence operation. We want to use the same question. Okay, don't even worry. Let's use the question. So in this same question, let's assume we are using the old tax law. This is always jumping. Sorry, guys. Okay. Now, in this question, let's assume we are using the old tax law. Aisha shift that commenced business operation on 1/4/2003. If we are using the old tax law, we would have said from the date of commencement 1/4/2023 to 31st/12/2023. The next one would have said from date of commencement again 1/4/2023 to first 12 months, 31st/3/2024. Third one will be on preceding year basis 1/10/2023 to 39/2024. So when you look at these first assets, sorry guys, the thing is jumping. I'm trying to explain something. Oh. Okay. If you look at the first asset, Jesus Christ. Okay, look at this asset. Industrial building. The industrial building was acquired 1/2/2022, but let's leave that one because any asset acquired prior to the date of commencement, we have said it should be assumed that it is acquired on the date of commencement, but let's leave that one. Let's take this one. This second one that was acquired 1/4/2023. Now, when you look at your basis period, you will know that we can introduce these assets in this date, 1/4/2023. Look at this date that I wrote down the other time. When we said the company commenced operation, we said the company would have been assessed with that from date of commencement to 31st December of that year. So 1/4/2023 to 31st/12/2023. We can actually say these assets, plant and machinery, was acquired in this year based on our base period and was also acquired in this second year. Abi? And the reason for this is because there is overlapping of base period. That's why we will not be able to know when and where to allocate the assets. Now, what is the tax law saying? The tax law is saying when a company commences operation and during this commencement, there is overlapping of base period and you have assets to allocate. The assets will be allocated to the earlier period. So, because they have a common basis period now, we are saying the assets will be allocated to the earlier period. And in those years, what we usually do is we would have said, because we said it will affect the earlier year, the common period, the common basis period, this basis period is common to this period, and some of it to this period. So the common basis period will affect the earlier year. So I will now say 1/4 for capital allowance, suppose I will say 1/4/2023 to 31st/12/2023. Now, this is a common basis period to the 3 years. So it will affect the earlier tax year. Now, when I get to the second tax year, I will say a day immediately after the end of the previous one, which will be 1/1/2024 to 1/1/2024 to 31st/2024 is common to this period and this period. So it will affect the earlier year to 31st/3/2024. So what you're trying to do is to erase the overlapping of basis period. But with the advent of Finance Acts, when Finance Acts came, Finance Acts took out all this overlapping of basis period to the extent that we do not have any basis period that is going to be overlapping again. And by so saying, the same basis period that we use for capital allowance is the same basis period that we use for our profit. So, and you remember when we started this class, I told you when the company commences operation, the company will be assessed with tax from the date of commencement to 31st December of that, to the end of the first accounting period. Okay? To the end of the first accounting period. Therefore, so what we're saying here is that this company shall be assessed with tax from the date of commencement to the end of the accounting year. Okay? Now, the accounting year of this company is 30/9 annually, right? So I will say my base period will be from the date of commencement, 1/4/2023 to 30/9/2023. Now,
Who is that?
we have said, Anthony, mute your phone. We have said any asset acquired prior to the date of commencement will be deemed to have been acquired on the date of commencement. Therefore, this industrial building will be deemed to have been acquired on the date we commenced operation. Therefore, we introduce the 2024 tax year. The next one. The second tax year will be assessed with tax from a day immediately after the end of the first accounting year end to the end of the second accounting year end, right? So, which is this date? Now, which assets falls within this period? When we look at it very well, Industrial building and plant and machinery fall within this period, within the first year. When you look at this, 4/7/2024, 4/7/2024 will fall within this period. Therefore, motor furniture and fitting will be introduced in the second tax year. The next one, 7/7/2025. Where will it fall? It should not be in the first, it should not be in the second, it should not be in the second tax year, rather the third tax year. And you remember the third tax year shall be assessed to tax from the date of from a day immediately after the end of the second accounting year end to the end of the third accounting year end, which is this. Now, which assets fall within this period? When we go back, an asset that we acquired 7/7/2024, plant and machinery, will fall within this period. See, 7/7/2024, 2025 rather. 7/7/2025 is within this period. So we will introduce it in 2026 taxing. Same also for 10/7/2025. It falls within this period. We introduce it in this period. So that is how to allocate the asset to the relevant year of assessments. Now, having said this, the next thing that we need to also look at is they said an asset was disposed. When was it disposed? It was disposed 4th of August 2025. If that is the case, 4th of August 2025, the asset was disposed. So I'll come back to my basis period. Where would it fall? It will still be within this period. Okay? 4/8/2025 is here. So that means it was disposed in 2026 tax year. Any question? So now that we have known how to allocate asset to the relevant year of assessments, then we go straight to the computation of our capital allowance. So, having allocated the assets to the relevant year, are you seeing my screen? Please let me know if you are seeing my screen.
Yes, sir.
Yes.
Thank you. So, having allocated the asset to the relevant year that the asset relates to, then we now move to the computation of capital allowance. So, the first thing we need to do is to bring in all the assets according to what we have allocated the other time. You remember, we allocated this, that is plant and machinery, to this year, and also industrial building. Now, when we are calculating our initial allowance is calculated at the rate of 50% of the cost of the assets. You also remember that I told you that you do not prorate initial allowance. That initial allowance is calculated in full. So the examiner will give you all these rates. Do not cram these rates. At the back of your question, examiner will give this to you. Okay? So the first thing we need to do is to introduce our assets at cost in the first year of assessment. Okay? And our first year of assessment year is 2024. And these are our basis period. Now, initial allowance of this, 50% of this guy will give us this. 15% of this guy will give us this. Now we add the two together, we'll have our number here. The next one is our annual allowance. Annual allowance is prorated to the number of months in the basis period. Annual allowance is what? Prorated the number of months in the base period. Now look at our number of months. It is not up to what? 12 months. Therefore, we are going to prorate our annual allowance. Annual allowance should be prorated. Now, in the case of prorating the annual allowance, what are we going to do? So what we'll do is to say cost minus initial allowance divided by number of years multiplied by y over 12, where y is the number of months in which the asset will be put into production use. N is the number of years the asset is expected to use, expected useful life of the asset. We already have the cost and we already calculated the initial allowance. So we take them one after the other. Plant and machinery, the cost price of this plant and machinery was 4,999,000. Okay, so subtract initial allowance from it, that is 2.4 million divided by 4. Now, how many months is this? Who can tell me? You have to count it from April, May, June, July, August, September. That is 6 months, right? So 6 months. So we say 6 over 12 multiplied by whatsoever answer we get here. And it will give us this. The same thing for building. The same thing for building. For building also, we have 12 billion and 12 million and 760 naira minus 1,814. Okay, so divided by 10. Building is fair to use 10 because the annual allowance rate is 10%. Annual allowance rate for what's it called? Plants is 25%. So we say that will be divided by, we say 25 N is equal to 100% divided by annual allowance rates. And our annual allowance rate is 25%. So if I divide that, I will have 4 years. That is how we got this 4 years that we're using here. The same thing is applicable to this one. This asset is expected to use 10 years. How do we know it's supposed to use 10 years? The annual allowance rate for building is 10%. So I'll just say 100 divided by 10 and I'll get my answer. But don't forget that the building in our current basis period will be used for only 6 months. So 6 over 12, you get this answer. So that is it. So that's how we got this number and this number. If I add this together, I'll get this. Add it, I'll get this. So this is my total capital allowance for that period. In the second year, which is 2025, our base period will run from a day immediately after this one, which is 1/10/2023 to 30/9/2024. The period of assessments, the tax year, is going to be 2025. So if that is the case, I will need to get my tax return value. And what is my tax return value? Cost minus initial allowance minus annual allowance will give me this. This also will give me this, right? Now, in this year, did we acquire another asset? Yes, we did. Go to your table. We acquired furniture and fitting. So what is the cost of furniture and fitting? The cost of furniture and fitting is 2.4. We are bringing it in. So you introduce that one first, 2.4 million. Initial allowance on that. What is the rate? 25%. I'll call 25% of 2.4. I will have 600,000. Okay. So We will now say annual allowance. We need to calculate annual allowance. For this one, because the period is not less than 12 months, our annual allowance will be full. So I'll go back to my annual allowance computation. I'll go and compute. So I'll say for building, for plant and machinery, where the base period is 12 months, I do not need to prorate my annual allowance. So I will need to recalculate my annual allowance. So it will be 4.9 that we had the other time minus 2.4 divided by 4. It will give you the same thing for building, 12 million and 760 minus 1.8 divided by 10 years. You would have 10,206. So this is your annual allowance. Okay, the annual allowance. So having said that, we'll go back to our computation. So this is the numbers that we got. The same thing for this one. This minus this. This asset is supposed to use 5 years by the virtue of the rates. That will be 360,000. That is this minus this divided by 5. You have 360,000. You add it together. 2026. In 2026, I'll go back to my schedule. Did we acquire any assets in 2026? We acquire motor vehicle and we acquire plant and machinery too. Okay? And we dispose industrial building. You remember the characteristics of capital allowance where we said before an asset can enjoy capital allowance, the asset must be put in use at the end of the base period. It must be in use at the end of the base period. Now, that by implication, that means if they dispose any assets within the year, the asset that was disposed will be taken out. So this asset will be as disposed. So we take out the tax lineal value at disposal. So this is the tax lineal value at disposal of the assets. We take it out. In this year that the asset was disposed, we are not going to calculate annual allowance on that asset that was disposed. So we have disposed it. We acquire 2 additional assets, plant and machinery, so and motor vehicle. So this is the value. The rate is 50% for initial allowance, 50% of this, you have 5 million, 50% of this, you have 2.5. Add it together, you have 7.5 million. Remind me to send you this material. The other one is not complete. So, annual allowance is a constant thing. So, I bring my annual allowance that I calculated here. I bring it. I need to recalculate the annual allowance for this new assets. That will be cost, which is 10 million minus 5 million divided by 4. You have this. You have a question? You have a question? So the terminal value of this guy is 1444000. Now, annual allowance is a constant thing, so it remains constant, provided that there is you did not prorate the annual allowance in the first year. And the only time you prorate annual allowance is when a company commences operation. Because at that time, there's every possibility that the company will not have 12 months in their calendar year. So the same thing for this one, we calculate the annual allowance, which is cost minus initial allowance divided by 4. You have this. You add everything together, you have this. In 2027, this is the last year of use of these assets of this guy. And in that year, we must ensure that we terminate the life of these assets. And we must also retain 10 naira in the last year of use of the assets. So if I retain 10 naira, now look at the tax lineal value of this asset. If I remove this from this, I have this as my tax lineal value. So because I might dispose this asset later on in the future, I am going to reduce this one by 10. Meanwhile, that means I am retaining 10 naira. This other asset has been sold. There won't be taxing down value in 2027. That's why it is named. The taxing down value of this is 3,750,000. For this is 1080. This one is 18,775. Annual allowance is constant. So I'll just say I'll bring my annual allowance and I'll add everything together. I have this. This asset has completely exhausted its useful life. So I wouldn't need it again. So I will have 10 as my residual value in case I want to dispose these assets in the future. Sorry, guys. In case I want to dispose these assets in the future, I will have 10 as my residual value. So in 2028, the tax value of the first assets, which is this plant and machinery 2 and this, all this, amounted to this value. Annual allowance is constant. I will bring it again. By the time we add everything together, I have this value. And in my last year, because this we calculated this capital allowance for 2028 for a reason. And what is the reason? When you look at the profit the examiner gave us, the profit stopped in 2027, year ended 2027. That means these profits will be assessed to tax when? 2028. Because the profit will be assessed to tax in 2028, capital allowance that you are going to compute to should stop in 2028. That was why we took this capital allowance to 2028. I will stop it there. So the next one is for us to compute our balancing charge or allowance. You remember that this asset was actually disposed. The asset was disposed. And when the asset was disposed, it was sold for 18 million. And you remember we said when we want to calculate our balancing charge or allowance, what we are comparing is the tax down value at disposal. What we are comparing is the tax down value at disposal. So I will be comparing my 18 million naira, which is the sales proceed, with the tax down value at disposal, the tax down value we got the other time, which is 8670549. The difference between the two will be this. Now, another condition for capital for balancing charge is that balancing charge cannot be more than the total allowance claimed on the assets. So we need to calculate the total allowance claimed on the asset and compare the two. So my total allowance claim on the asset will be cost price minus tax union value at disposal. What is my cost price? My cost price is 12 million. My tax union value at disposal is 8 million. So that means before I sold these assets, the total allowance I claimed on the assets is 3 million. According to the restriction rule for balancing charge, we say balancing charge cannot be more than total allowance claimed on the assets. So the total allowance claimed on the asset is 33330221. So 33330211. That is 3 million naira. Abi? So and you have your balancing charge that you calculated based on the formula that we know to be 9 million. So we are saying that you cannot take more than 3 million because that is what the law says. You have to restrict to the total allowance claim on the assets. So in restricting to the total allowance claim on the assets, I will have 3 million, not 9 million. Okay. So that is that. So total balancing charge that we are going to claim now is 3 million, not 9 million naira. Do you have any question? That we're going to charge rather. we will charge this not 9 million. Do you have any question? Do you have any question? Okay, in the absence of no question, we'll go and compute, because the examiner asks us to compute the company's income tax liabilities for the relevant year. Now, when this company commenced operation, the company commenced with the profits of this. You remember, from the date of commencement to 30th September 2023, you have an simple profit. Let's go back to the profits. So look at it. You remember, I told you whenever you see period to, it means from the date of commencement to this date. So from the date of commencement to 30th September 2023 gave us 3 million. Now, what is our rule? The rule says when a company commences operation, the company will be assessed with tax from the date of commencement to the end of the first accounting year end. Now, in this situation, the end of the first accounting year end is 30/9/2023. No calculation is required because this date coincides directly with what the question gives us. Therefore, we just choose the profit. I take the profit that we have in the question. Now, capital allowance that we calculated 5,117,021. That's what we calculated. Now, after the calculation, we have to check for, because it's a trading company, it's not a manufacturing company. So the capital allowance cannot be more than 2/3 of the assessable profit. So 2/3 of the assessable profit of this guy, 2/3 of this will give us this. That means the maximum you can take is this value. So you cannot take the entire 5 million because there is no even profit to take care of that. So 2/3 of that will give us this. We subtract, these are capital allowance, 2/3 of this, subtract it from this, you carry this balance forward. You carry the balance forward. Now remove this from this, you have this. On this, I'm going to calculate my total profit. And on my total profit is this. Tax liability of 30%, we have this. Education tax, 3% on my profits. So I will have this. We are done with that. The next year, our assessable profit shall be the profit for a period of 1/10/2023 to 30/9/2024. Where can we see that in our question? We go back to our question. In our question here, this would have started from a day immediately after this. That means one 2023. So when you look at that, to these dates, is the same thing that we have when we are calculating, when we wrote our basis period. So I'll just pick that figure, no calculation is required. I'll pick that figure, which is this. I've picked it. Capital allowance brought forward. I am bringing this forward for this year. Capital allowance for the year, the one we calculated. We calculated 2.6 million in the second year. Let's see. 2.6 million was calculated in the second year. So 2.6 million. But look at our profits. Our profit is 23 million, which can absorb both the previous capital allowance that we have and the one that we have for the current year. Add one. If I say 2/3 of 23 million, it's like 18 million, thereabouts. I'm coming. 2/3.
So it's 50 million.
15 million. Now, when you add these two together, is it up to 15 million? No. So that means we don't need to restrict the capital allowance. That means we don't need to restrict the capital allowance. Therefore, I'll take the entire value and relieve it against my profits. On that, I will have my tax liability of 30% and education tax of 3% on your assessable profits. 2026 is a peculiar year. Our assessable profit is 32 million. There was disposal, and we made profit on that disposal, which is a balancing charge. So our balancing charge is 3 million. You remember we got the balancing charge that time, 3 million. Capital allowance for this year was 10 million. If I take 2/3 of 32, I will have 21 million. So the 21 million is even more than this. So I do not need to restrict my capital allowance this year. I'll take the entire value. So my total profit is this. I will multiply it by 30%. I will have this value. I will multiply my education tax by 30% of the assessable profit. I will get this value. In 2027, the same thing is applicable. Our profit is 22 million. What is our capital allowance for the year? Our capital allowance is 3 million. If I take 2/3 of this, is about 2/3 times 22 is about 14 million. 14 million is more than this. I don't need to restrict my capital allowance. I take everything. The same thing applicable to 2028. Now, my question to you, and everybody will answer this question, is if this company is not a trading company, assume it's a manufacturing company, would your answer, with what you have gotten now, would it change? I'm listening.
No, sir, it will not change.
It will
Okay.
change.
Thank you, Deborah. It will change. Who said it will not change? Another person.
You know, it was not restricted, you know. A manufacturing, you won't restrict.
It will change in the first year of assessment, it will change.
Yeah, the company
Okay,
income
the
tax.
first year will only change.
Why will it change the first year of assessment?
That restriction on the capital allowance now
Jerry,
is not applicable to the other in the other distance sector, not trade.
so we should not apply restriction, right?
Yes, sir.
Jerry, you have not completed your statements. We are not going to apply restriction. Okay.
Yeah, it will not apply that restriction if it's on the other sector.
Go ahead.
I said that
manufacturing or agricultural business.
Yes.
Say it. Is that what you said?
That's what I said. I said that the restriction will not apply in manufacturing. So that restriction will not hold. That's what make the answer different from what we done now.
Good. The answer will be different from what we have done now. And the reason is because of restriction of capital allowance. You are not going to restrict your capital allowance in the second year. Sorry, in the first year and going forward. So in this one now that we did, we have restricted the capital allowance. Abi? What we are saying here is that you will not restrict your capital allowance. The capital allowance should not be restricted at all. So that is that. So I think with this, we are done with capital allowance. But I quickly want to open your eyes to one implication of Finance Acts. It's not in this your study pack. I will put it, but let me open it from my textbook so that we can quickly enjoy it together. I am thinking that the examiner might want to test that part. Is that the one I want to open? Take time.
So please assist and share this material since there are a few modifications after the lecture, sir.
I'll share it.
Thank you, sir.
What that section of capital allowance is saying is that capital allowance for a company will be restricted. Will be restricted to 20%. Will be restricted rather, where not more than 20% of the asset of the company, of the income of the company, is from non-taxable income. That's another restriction of capital allowance. What are you seeing on my screen currently? You are still seeing the old material, right?
Yes, sir.
Yes, the old material.
Okay, I want to share the new one. What can you see on my screen now? Are you seeing like a textbook?
Yes, sir.
So let's talk about this. It's very important because the examiner has not tested it before now. So they can actually test it. Trying to go to where it is. Yeah, this is it. Okay, let's talk about this section. If you are there, I'm there. So what is this section saying? Okay. So there are situations where companies make income from both non-taxable income and taxable income. And this company will now go ahead and claim capital allowance on the company as a, they will claim capital allowance. And knowing fully well that where we see non-taxable income, what we usually do is that we say it is not taxable. Meanwhile, when you are claiming capital allowance, you are claiming capital allowance on everything, both taxable income and non-taxable income. Meanwhile, we have said non-taxable income is not allowed or is not taxable. So what the ad is saying here is that where the proportion of non-taxable income is not more is more than 20, does not exceed 20%, what's it called? The capital allowance will be restricted. This is what we are saying. Based on this agreement, capital allowance or qualifying capital expenditure utilized for generating taxable income and non-taxable income shall be prorated such that only the portion related to taxable income shall be allowed. Only the portion related to taxable income shall be allowed. Now, what are we saying here? However, full relief will be granted where the portion of non-taxable income does not exceed 20%. So what we are trying to say here is that we can grant the taxpayer all the capital allowance. We can give them, say, okay, this capital allowance will be allowed for you to deduct. But in the presence of non-taxable income that is now more than 20%, we need to restrict the capital allowance to only the portion of taxable income. That's what we are saying. So let's look at an illustration. Look at this illustration, for example. I'm going to send you this part too, so that I can have it. Now, Farouk is a trading company that has been in business since 2015 and makes up its account to 31st December annually. The company's total income for the year ended 31st December 2000 is as stated below. Dividend received gross, 35 million. Profit on disposal, 7.5. Other income, 57 million. Total, 100 million. Additional income, additional information relates to the company include the following. Net profit, 15 million. Capital allowance brought forward, 2 million. Capital allowance for the year, 10 million. Note, capital allowance for the year is very important. Before arriving at the net profits, where you were informed that depreciation of 12 million and renewal of long-term lease of 20 million were included. You are required to calculate the capital allowance and income tax liability for the relevant year of assessment. Now, the first thing you do is to get the proportion of the taxable income and non-taxable income, right? Now, in this question, what are the taxable income here and what are the non-taxable income? In this question, we have dividend is a non-taxable income. Profit on disposal officer is a non-taxable income. So what is the proportion of non-taxable income here? Who can guess this for me? Who is getting that for me? Proportion of non-taxable.
42.5.
42.5 is the proportion of non-taxable income. By implication, that means the capital allowance should be restricted in this regard. Assuming the proportion of non-taxable income is not up to 20%, we don't need to restrict our capital allowance. Do you understand me? Let's say that again. If the proportion of your non-taxable income exceeds 20%, then you are going to restrict the capital allowance. But if it does not exceed 20%, the capital allowance should not be restricted. In this situation, is our non-taxable income, did it exceed 20%? The answer is yes. Now, since the answer is yes, that means our capital allowance for the year will also be restricted by that proportion. Will be restricted. You cannot take everything. So let's go. So this is the analysis. The non-taxable income, for the purpose of our capital allowance, this is what we are going to use for the allowance that we're going to grant. Okay? Now, the non-taxable income that we have there is 42%. Taxable income that we have here is 48%. That means 57.8%, 57.5%. That means in calculating our capital allowance that is going to be allowable for this year, okay, it has to be the capital allowance. I told you if the capital allowance is more than 20%, you have to restrict it. So what percentage of it did it go beyond 20%? Is about 42%. Is 42%. So this 42% will be restricted. So the capital allowance for the year that we have is 10 million. The capital allowance for the year that we have is 10 million. So 42% of this represents non-taxable income. Therefore, we're going to remove it. So we are removing the 42%. So what we are going to allow, technical capital allowance allowed for the year is 57%. 57% of this, of 10 million will give you this. Or just say 42%, 42.5% remove of 10 million will give you this. The balance is what is going to be allowable for the year. So these are allowable capital allowance for the year. Do you have any question? Any question?
Can I see the? Okay, please. My question is that on agriculture and manufacturing, you said for the first question, you said if it was not if it was agriculture, we're not going to restrict anything. They're going to deduct the capital allowance for the first year that was more than the profit. That means we are going to there'll be a negative
Yes. So when you are claiming capital allowance, thank you, Debbie. Who is that? Gloria. When you are claiming capital allowance, the capital allowance that you want to claim cannot be more than your profit in any year. So that means the balance will be carried forward. Do you understand me, Gloria?
Okay, yeah, I'm talking about not this
I know
question.
now. I'm responding to you. You remember that we have 3 million and our capital allowance is about 5 million in the first question, right? So we are saying that you cannot take more than the profits. So the maximum you can take that year, even though the law says you can recoup everything. But if there is no profit to recoup it, you carry the remaining balance to the next year. Do you understand me?
Yes, sir.
Good.
Okay. Then for this one, please, can I see the where you compute the capital allowance before for you to get this 10 million?
Already gave us capital allowance of 10 million.
Okay. Yes.
They gave us this question. Look at it in the question. For the year, 10 million.
Okay.
That's why we calculate anything again. So now, right. Yes.
Yeah, from this new this section 31 of Finance Act that you just said now, if it's going to be tested, will the examiner give us a clue that maybe we should do 20%, that if it's not more than 20% of the I'm listening, sir.
Lero. I just laugh you for here. Examiner will not tell you. It is you that will determine that. Examiner will not tell you. When a question is tested, examiner expects that you should know all the principle. Okay? Examiner will not tell you. In your mock exam that I'm going to set, I'm going to play a scenario of this in your mock exam so that you will see it. Okay? So in that Aisha sheet that we did, we can also extend it to this one. You know, what the examiner will give you is your profits, your income. So if the income is non-taxable income portion is more than 20%, you are going to restrict the capital allowance the taxpayer will get that year. Do you understand me? So, for example, in the one we calculated the other time, let's assume we are now given the non-taxable income is now more than 20%. What we are going to do is that we are restricting it to the portion that is allowable. So the allowable portion will be the difference between what you have. So non-allowable income, non-taxable income here now is 32%. The allowable one here or taxable income is 57.5%. So this 57.5% is what we are going to use to multiply our capital allowance that will be allowed in the year. So imagine you have restricted the capital allowance to 2/3. You are still going to do a further check of your income. If your income is more than non-allowable is more than 20%, then you restrict it further. That's what we are saying. You will see a scenario question when I bring it on. So the examiner asks you to calculate your tax liability. So the first thing you need to do is to bring your net profits, right? So the second one is to remove your non-taxable income, add back non-allowable expenses, and you bring in your capital allowance. You remember how we got this capital allowance? This capital allowance was a result of this our calculation here. So that is that. And you relieve everything from your profits to get
So,
your
I
total
have a
profit
question.
and company income that. Yeah, Debbie.
Okay, so please, in
Go
your
ahead, Debbie.
calculation of capital allowance, how did you get the 4,250? I'm just trying to see how you got that, but I don't understand. Like, go up.
Okay.
No, in the calculation of capital allowance that
Okay.
you did. Yes, 4,250,000. No, not yet. Yes, this one. 4,250,000. I really don't know how you got it.
This percentage
Okay. On what?
on the total capital allowance for the year.
Oh, okay.
Okay. So that's that. I'm going to add this one too as part of your as part of the material I want to send to you so that you can read it. If you have any question, you come back and ask. So that will be the end of today's class. Our next class, by the grace of God, we are going to be looking at company's income tax. I might not teach you next week Saturday, but I'll organize someone to teach you. But it's not going to be company income tax. Maybe Mr. Idris will take the class next week Saturday. Maybe I might take the class on Monday, depending on how free I am. But I'll let you know. I'll communicate with you guys. All right. Good night. Good day, guys.
Sir, before we go, please can you go to that question, that first question we solved?
Okay. Just give me. Come in. You want to open it again? Okay. Yes, this is it. Come forward. We paste that.
Sorry, sir. Mr. Chris.
Yes.
Okay, sorry, what page? What you just touched now, the whole 20%, what page is it? Because I don't think I can see here in the textbook I'm holding.
No,
Not here.
it's not there. I'm forwarding it. I'll send it to you guys after the class.
Okay.
Okay. Gloria, you wanted to ask a question?
Yes, it's because I think it's when if I see that question, like if I'm looking at it together, because I didn't really get that agriculture and manufacturing parts. I didn't really get it. We are saying that the capital allowance of 5 million will not be will restrict it. I mean, no, it's like we're not going to restrict it, we will deduct everything for that first year.
Yes. I said so.
And the profit to be it will be negative. It will be a loss.
And I said you cannot get lost. So
That means
let's
that
go
we're going
back to
to
the question. So you cannot do it. You can't get more than the profits. You can't get the capital allowance cannot be more than the profits. You get.
Okay.
So when
Yeah.
you have a capital allowance of, let's say, for example, 5 million, in this question, so it's 5 million, and you now have a profit of 10 million. Sorry, profit of 3 million. Okay. So the maximum you can get, even though the act has said you do not need to restrict capital allowance, you are not restricting it, but your profit can only take what's it called? Can only take to the tune of the 2 million that you have. So the remaining 3 million you carry forward. I'll show you the question, the solution to that question now, so that you can see what I'm saying. Okay, let me share my screen again. Let me share my screen again. So this is a situation. Okay, good. This is a situation where the company is a manufacturing company. Look at it here. Now,
Okay.
you will see that the company had a profit of 3 million and our capital allowance was 5 million. We said there is no restriction to capital allowance. We do not do receipt of 2/3. Unlike this one, I said 2/3. Look at this one. We said 2/3 of your profits. Here, we did not say 2/3. We just took the entire profit because we said for manufacturing company, you do not restrict the capital allowance. So I've taken the entire profit. But I cannot take this 5 million this year because I do not have sufficient amount to relieve it on. Okay? So the balance of this, I will carry to the next year. Do you understand me,
Yes.
Gloria?
Yes.
So, and also check. So in the next year, I am not restricting my capital. I'm not doing 2/3 of anything. I'll just take everything and take it out of my profit. Let's assume that this one is 21 million. You're just assuming.
Okay.
So let's assume it's 21 million. I would have said, well, let's say 20 million so that it will not be more than that guy. I would have said this plus this. That's going to be about 22 million. I'll just say the 22 million, I'll remove it from the profits. Do you understand me?
Yes.
Okay. There is no, I will not do 2/3 of this to check. I'll just take the entire thing. Meanwhile, 2/3 of this is about 17 million or 15 million thereabout. Abi? So I will not restrict to, I'll just take the entire 22 million. That's what we are saying.
Okay, because this is a manufacturing or agricultural company.
Manufacturing or agricultural company.
Okay.
Yes, that is it. I'm sending you this material. You guys can have it.